Welcome to your guide to understanding bonds. In the world of finance, there are many investment avenues, each with its own set of complexities and unique characteristics. One such avenue that often sparks curiosity, yet sometimes feels shrouded in mystery, is the fascinating world of bonds. But fear not, dear reader, for we're about to embark on a journey to demystify these financial instruments and empower you with the knowledge to navigate the world of bond investments with confidence and clarity. Bonds, in their simplest form, are loans that you, the investor, make to borrowers, typically governments or corporations, who need funds for various projects or operations. Think of it as lending money to a friend, except in this case, you're lending to entities with much greater resources and financial stability. These borrowers in turn promise to repay you the principal amount, along with periodic interest payments known as coupons, for the use of your funds, providing you with a steady income stream. Throughout this comprehensive guide, we'll delve deeper into the intricacies of bonds, exploring their various types, the benefits they offer, and the potential risks involved in bond investments. We'll unravel the jargon, provide practical examples, and equip you with the tools you need to make informed and confident investment decisions. So, whether you're a seasoned investor looking to diversify your portfolio, or a novice just starting your financial journey, this guide will serve as your comprehensive roadmap to understanding the world of bonds and unlocking their full potential. Welcome to Section 2, Demystifying Bonds, What They Are and How They Work. In this section, we will break down the basics of bonds and how they function in the financial world. Imagine this. You have some extra savings and decide to invest in a bond issued by a well-established company. This decision can be a strategic move to grow your wealth steadily. This bond has a maturity date of 5 years and an annual interest rate or coupon rate of 5%. The terms are clearly defined from the start. Here's how it works. You, the investor, lend the company a certain amount of money, known as the principal. This principal is the foundation of your investment. In return, the company promises to pay you a fixed interest payment, the coupon, every year for 5 years. These payments are your returns on the investment, and they will repay the principal amount you lent them at the end of the 5-year period, the maturity date. This marks the completion of the bond's term. Essentially, you're acting as a lender, providing the company with capital, and they, in turn, are obligated to make regular interest payments and eventually return your initial investment. This mutual agreement benefits both parties. Bonds are considered fixed income securities because the interest payments are predetermined and remain constant throughout the bond's term. This stability is a key feature. This predictability makes bonds an attractive option for investors seeking a steady stream of income. It offers financial security and peace of mind. Now let's delve into the different types of bonds available to you. Each type has unique characteristics and benefits that cater to different investment strategies. Welcome to Section 4, Why Bonds Matter. The importance of diversification. Imagine putting all your eggs in one basket. If you drop the basket, you risk breaking all your eggs. The same principle applies to investing. Putting all your money into a single asset class, such as stocks, exposes you to significant risk. This is where bonds come in. Bonds play a vital role in a well-diversified investment portfolio by providing a counterbalance to the volatility of stocks. When stock prices decline, bond prices tend to be less affected, acting as a cushion for your overall portfolio. Diversification is key to mitigating risk and achieving long-term financial success. By including a mix of asset classes, such as stocks, bonds, and real estate, in your portfolio, you can reduce the impact of fluctuations in any one asset class on your overall investments. Section 5, Risks and Rewards. Understanding the trade-offs. As with any investment, bonds come with their own set of risks and rewards. Understanding these risks is crucial to making informed and strategic investment decisions. Let's explore some of the key risks associated with bond investments so you can navigate them effectively. Interest rate risk. When interest rates rise, the value of existing bonds tends to decline, impacting your portfolio. This is because investors can purchase newer bonds with higher interest rates, making existing bonds less attractive and less valuable. Inflation risk. Inflation erodes the purchasing power of money over time, affecting your returns. If inflation rises faster than the interest rate you're earning on your bonds, your investment returns may not keep pace with the rising cost of goods and services, diminishing your real returns. Credit risk. This risk applies to corporate and municipal bonds, which are not without their own challenges. There's a chance that the issuer may default on their debt obligations, meaning they may not be able to make interest payments or repay the principal amount, leading to potential losses. While bonds generally carry lower risk than stocks, it's essential to assess your risk tolerance and investment goals before investing, ensuring they align with your financial strategy. Section 6. Bond ratings, assessing creditworthiness. Just like you might check a restaurant's hygiene rating before dining there, it's crucial to assess the creditworthiness of bond issuers before investing. Bond rating agencies such as Standard & Poor's and Moody's provide ratings that reflect the issuer's ability to meet their debt obligations. These ratings range from AAA, which is the highest credit quality, to D, which means in default. Bonds with higher ratings are considered safer investments, while those with lower ratings carry higher credit risk. Understanding bond ratings can help you make more informed decisions about the level of risk you're comfortable taking on. Section 7. Interest rates and bond prices, an inverse relationship. One of the fundamental principles of bond investing is the inverse relationship between interest rates and bond prices. When interest rates rise, the value of existing bonds tends to decline, and vice versa. Think of it this way. If you buy a bond with a 5% interest rate and interest rates subsequently increase to 6%, your bond with the lower interest rate becomes less attractive to other investors. As a result, the price of your bond will likely decline to reflect the lower demand. This inverse relationship highlights the importance of understanding interest rate movements and their potential impact on your bond investments. Section 8. How to invest in bonds, a step-by-step guide. Now that you have a solid understanding of bonds, let's explore the steps involved in investing in them. 1. Determine your investment goals and risk tolerance. Before investing, it's crucial to identify your investment objectives and how much risk you're comfortable taking on. 2. Choose the right type of bonds. Based on your goals and risk tolerance, select the type of bonds that align with your investment strategy. 3. Decide on a brokerage account. You'll need a brokerage account to buy and sell bonds. Choose a reputable brokerage that suits your needs. 4. Research and select bonds. Conduct thorough research on different bond issuers and their ratings to identify bonds that meet your criteria. 5. Place your order. Once you've selected your bonds, place an order through your brokerage account, specifying the quantity and price you're willing to pay. 6. Monitor your investments. Regularly review your bond holdings and make adjustments as needed to align with your investment goals. Section 9. Bond funds versus individual bonds. Choosing the right approach. When it comes to investing in bonds, you have two main options: bond funds and individual bonds. Bond funds. These funds pool money from multiple investors to invest in a diversified portfolio of bonds. They offer instant diversification and are managed by professional fund managers. Individual bonds. Investing in individual bonds gives you more control over your bond selections. However, it requires more research and may not provide the same level of diversification as bond funds. The best approach for you depends on your investment goals, risk tolerance, and the amount of time and effort you're willing to dedicate to managing your investments. Section 10. Practical examples. Putting it all together. Let's illustrate the concepts we've covered with a couple of practical examples. Example 1. You're a conservative investor seeking a steady stream of income. You decide to invest in a bond fund that holds a diversified portfolio of U.S. Treasury bonds. This approach aligns with your low risk tolerance and provides you with regular interest payments. Example 2. You're a more aggressive investor willing to take on higher risk for potentially higher returns. You decide to invest in individual corporate bonds issued by companies with strong growth potential. While this approach carries higher risk, it also offers the potential for greater rewards. Remember, these are just examples, and the best approach for you will depend on your individual circumstances. Section 11. Conclusion. Embracing bonds for a secure financial future. Bonds, often perceived as complex financial instruments, are, in essence, loans that provide investors with regular interest payments and the return of their principal investment upon maturity. By understanding the different types of bonds, the risks and rewards involved, and the strategies for investing in them, you can unlock the potential of bonds to enhance your overall investment portfolio. Whether you're seeking a steady stream of income, capital preservation, or diversification, bonds offer a range of options to meet your investment goals. As with any investment, thorough research, careful planning, and a clear understanding of your risk tolerance are paramount to success in the world of bond investing. So, embrace the world of bonds, empower yourself with knowledge, and embark on your journey towards a more secure financial future.